Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer at Worth Asset Management. Today is September 6, 2022, and I'm going to go over your three threes for the week. I'm going to go over the top three market movers and some of the economic data for the week. I'm also going to go over our favorite three asset classes and some of their performance, and how we are newly positioned in the equities and on the bond side. So let's jump on in. Okay, let's go over the top three market movers for the week, September 6, 2022. Number one, we're going to go over some economic data from late last week and this week. And number two, we're going to go over a chart of the week, which is European inflation and rates. And number three, we're going to go over our Fed balance sheet and quantitative tightening. All right. Last week, we had our big jobs number that came out on Friday. The employment report for August was 315,000 new jobs versus an estimated 270,000 jobs. So how does that look on a graph? This is kind of a Goldilocks number. This wasn't too hot, not too cold, came in about 315,000. They did do some revisions. They revised July's down by 2,000. They revised June by a whopping 105,000. So that was kind of big. Okay, so that we got to keep an eye on that. But some of the largest gains came from the business service sector, which we like to see, education and health, retail, and leisure and hospitality. So let's take a look at the unemployment rate. The unemployment rate actually ticked up from 3.5 to 3.7, and this rate increase is actually a positive. And it's a positive because the labor force grew by 786,000 people. So more and more people were getting back out and finding jobs where they weren't in previous months. So that is a positive. So as long as that labor force continues to grow, we could go higher on the unemployment rate, okay? All right, so let's talk about this week. We still have some more Fed governors and speakers coming out on Wednesday and Thursday. We also have a busy week because we have Australia, we have Europe, and we have Canada having interest rate meetings. So they will be adjusting and moving their interest rates, so we've got to keep an eye on those. Also later today, we'll have the ISM non-manufacturing services PMI for August and the Fed's Beige Book. So let's take a look at the ISM. Okay, now it's estimated to come in at 55.5 later today, and that is consistent with expansion. When we get in the 50, lower 50s and below 50, that's the recessionary periods that we've seen in the past. So 55.5. So there is some green shoots out there. Okay, there are some positives are coming, and this is one of them. But keep in mind that sometimes right now that this market is looking at good news is actually bad news, because that means the Fed is going to continue to have their foot on the pedal and raise interest rates to fight off inflation. On Wednesday, Apple will host its annual product launch called Far Out, man. And they will be announcing a new iPhone 14 and an Apple Watch. On Thursday, the ECB, like I said earlier, will have their policy meeting and their interest rate decision on what they're going to do with this interest rates, which leads us into our chart of the week. This is a chart of the Eurozone inflation versus the short-term interest rates. Okay, now they're expected to raise their interest rates by 50 basis points, or some saying 75, like what we're doing. However, they have had negative interest rates since 2014, and just recently they raised it 50 basis points to get it basically to zero. Okay, they're actually 0.04, and that's because their inflation rate hasn't peaked. It is still going up, unlike ours that maybe has peaked. All right, at least temporary, or maybe that was the top. Theirs is still going up as of August, okay? And so there's this huge gap here. So they've got a lot of work to do. So you thought we were behind
on raising interest rates. They are, what I feel, very far behind. They've got a lot of work to do here, and they are still not done or have even come to their peak. Matter of fact, some of their prices are going up 2, 3, 40 or 40% higher. Some of their utility rates are skyrocketing, and that's not even to mention what's going on with Russia and the pipelines, et cetera. So I think they've got their work cut out for them, and we're going to have to keep an eye on them because that's going to affect us. All right, so number 3, let's take a look at our Fed's balance sheet and quantitative tightening. So not only is our Fed raising interest rates, they are pulling back on their balance sheet. And since the April peak, they pulled back 139 billion. Okay. However, over the last 3 months, our Fed has reduced the balance sheet by 52 billion, which is equivalent to 17 billion a month. They were supposed to be doing 45 billion a month. Okay, so they're doing less than what they're supposed to. Now it gets a little challenging because they're supposed to be tightening by 95 billion starting this month. Now they could even do 45 billion. I don't know how they're going to be able to do 95 billion, which is 5.5 times greater than what they were doing, but we shall see. We'll hope that they keep doing it, but let's kind of pan out and see how this looks on a longer term basis. Well, the period that we just looked at was right here. Okay, it's very small, right? Well, from 2007 through 2022, the balance sheet has gone up tenfold. So they have been increasing their balance sheet like gangbusters. And even after COVID, it went up 76%. And after COVID in 2021 to 2022, it went up 19%. Okay, so they've got their work cut out for them. Not only to raise interest rates, they're trying to reduce the balance sheet to fight off inflation. Both of them do have good effects to fight off inflation, and they're trying to do both without turning us into a major recession. All right, but let's go over the top 3 asset classes on a long-term basis. For September 6, 2022, nothing has changed. We still have T-bills, the US dollar, and utilities are our top 3 asset class. So that tells us defense is still on the field and the primary driver of this market. So let's take a look at some of the performance for those 3 asset classes compared versus our bond index and our equity index. Okay, on a 1-month basis, the bonds and the equities were negative, while the defense was positive. On a 3-month, they were also negative, and the majority of them, this one was slightly negative, but for the most part, they're positive. On a longer term basis now, scanning out to year to date, very negative, double digits, and we were positive across the board. So basically, again, like I'm sharing with you, the defense is the primary driver of this market and will continue until that changes. So let's take a look at on a short-term basis. Okay, we go over this every week. 6, 7 weeks ago, we were nibbling at bonds, had a nice little run. They turned right back over, and now we went into protect mode once again. We did that back at the end of 2021, and it helped us navigate the bonds selling off and going down over 10%. Well, we're out of bonds for the majority, and their since have already started to go down even more as their yields are going up higher as the Fed is raising interest rates. Okay, and same goes for the equities, right? We went right back to protect mode on August 30th, right here. And so this was we got in, had a nice little run, turned right back around, right back to safety. So this is the second time now, the second bear market rally. This one was about 8, 9%, and then this one turned out to be 18, 19%. And now we're back on defense. So are we going to have another one? I don't know. But right now we're right in the support zone as of Friday. And if this support zone doesn't hold, we will retest the June lows. Okay, so it's important for this June to hold, but we're in safety. We're going to wait and see. and kind of go from there. And maybe we'll have another buying opportunity, another bull market rally down the road. We'll wait until we get there. But right now, defense is on the field and will remain there until we see otherwise. That's it. Thank you for joining us. Our next update will be again next Monday at September 12th. And as always, please subscribe, like, comment. We do these videos for education purposes to help out our existing clients and others. So that's it. Have a wonderful week trading. We'll see you next week. Thank you.